As many of you know, I'm not particularly a huge fan of high dividend yielding stocks, at least for me right now, just based on my investor profile, which pins me as an early 30s investor with plenty of time to spare in the market. Now, that really just means that I'm more focused on dividend growth oriented stocks than this high yield. However, every now and again, there are in fact some higher yielding dividend stocks that do in fact catch my attention. And more than that, they're perfect for some of you out there actually looking for more dividend bang for your buck. So today I wanted to run through 6 such opportunities with all of you. So if high dividend stocks are in fact your go-to, you at least have a pretty solid list to work with from me. Now, with that said, I also want to just share with you that as of our latest inflationary reading, well, it came in with inflation hitting our expectations at 2.7%, which means we very well could see another interest rate cut coming our way in soon. And that very well then may fire up a lot of growth stocks out there, which would give way naturally to some more opportunities for us dividend investors as more investors focus on growth. But we're going to table all the economics for now and just get down to our high yield dividend stocks for the day, which, by the way, all of them meet my strict criteria to make it onto the list in the first place of a strong brand name, good leadership team, and more importantly, a clean balance sheet. So we can now at least sit comfortably in knowing that none of these dividends are going to be cut anytime soon. But with that said, the first mention is Genuine Parts Company, ticker symbol GPC, which is a company that's in the business of distributing automotive, industrial, and electrical replacement parts and materials. It's a low-key necessity across various industries, making it really ideal for dividend investors seeking stability. Now, as of this video, Genuine Parts Company is hovering in the red territory, which makes sense given our current economic environment, as businesses as well as consumers have both actually been cutting back. So we're going to see here that's only trading right now for $122 per share after some highs this past year over $160 per share. Now, clicking to that 5-year chart, we can see the powerhouse that Genuine Parts Company is, up over 16%. And more than that, scrolling down, we're going to see a strong influx of revenue year in and year out. But what matters most, at least in my opinion, is the balance sheet, to which we're going to see plenty of health there as well, with over $17 billion in assets with just $13.5 billion in liabilities. Now, we can see that there are in fact some increases there in total assets by over 8%, so doubtful that we're going to remain in the red forever. But I wanted to go ahead and just jump right into Simply Safe Dividends with you. We're going to find a safety score at an 80, a reliable dividend yield upwards of 3.25%, and scrolling down, a healthy payout ratio here at 45% after 67 years worth of a dividend streak. And while it might be low, it's continued to grow here by 6% year over year. Now, perhaps you want to take on a bit more risk in terms of the dividend income. There is an opportunity right now with Polaris, ticker symbol PII, which is actually an automotive manufacturer, not cars. We're talking about manufacturing motorcycles, ATVs, watercraft, and all of the alike. So in my opinion, more of a leisure and luxury type of business, which you can then imagine that it likely wasn't faring all too well under our current financial challenging times. Therefore, we're going to click into the stock chart. We're going to get red all year long with Polaris actually tanking down on the year by 32%. Clicking over to the 5-year chart, really doesn't look all too much better, down 35%. Right now, trading for just $63, making it very undervalued. Now, scroll down with me, and we're going to see that despite the hardships, revenue has actually increased on the year by over 4.3% and net income by over 12%. Now, on top of all of that, we will get a clean balance sheet here. Assets remain up over liabilities by about $1 billion plus, with assets here up over 5%. However, I said this is riskier when it comes to a higher yield. So here we are with the safety score at a 70, a tad lower, but a 4.12% dividend yield. Scroll down with me. We're going to get that payout ratio at 61%, higher for most companies that are like Polaris, but a 28-year dividend history. And at least as of this video, Polaris is still delivering through on solid dividend growth, up over 11% on average there. Now, I'm going to switch gears back into a more reliable lane with you in terms of a dividend stock that used to actually be a major player within my personal portfolio before I cracked down on getting real with myself in terms of my profile. We have Johnson & Johnson, ticker symbol JNJ. Now, I cannot speak highly enough about this dividend gem for the elder investors out there. It's a company that has been around, of course, for decades while revolutionizing the entire industry, whether it's been their medical device segment or their pharmaceutical segment. But when it comes to Johnson & Johnson, it is just all about when to actually buy in order to hold it for the longer term and, of course, just collect on the dividend cash flow, which I was doing for some time. So right now would be, in my opinion, the opportune time to buy in if you're interested in J&J. It had a very nice run up this year before actually faltering back down to its current share price of $146 per share. However, click into the 5-year chart with me and we're going to see that it's pretty consistent here, up only 3% nominally, but trading sideways isn't always a bad thing, again, depending on when you're actually investing into it and where you're at in life to avoid volatility swings. But scroll down here with me, you're going to see that Johnson & Johnson has very healthy revenue flows, and in addition to that, a very clean balance sheet, whereas assets trump over $167 billion with liabilities just around $98 billion. So talk about a very comfortable split. And now I want to present you with Johnson & Johnson's dividend metrics because I think you're going to absolutely love them. Simply Safe Dividends has J&J rated as a 99 in terms of a safety score, dividend yield coming in at 3.39%. And if we scroll down, you're going to see it only has a 47% payout ratio, which is in fact very healthy, a 108-year history worth of paying dividends. Now on top of that, do note that it is still in fact growing by about 8% on average year over year, which is quite impressive. And just like that, 3 dividend stocks down, that means we have 3 more to go. Before I actually run through the next 3, some personal YouTube stats for all of you. As of this recording, roughly 53% of you are not subscribed, but you do keep tuning in video to video, which is beyond me, and I just can't understand it. But after a couple of weeks of asking you to actually commit and subscribe to join this journey, that number actually came down from 70% to 53%. My goal is 50%. So a big thank you to all of you who subscribe, but a big ask for those of you who are still just tuning in video to video. Subscribe now, join me on this journey. While you're at it, tap on that thumbs up button just to let me know that you are in fact enjoying these videos and getting value from them. With that, I want to get right back into it, and we're going to go ahead and check out, well, one of the companies that I am also insanely bullish on in the healthcare industry. It's a great opportunity, Medtronic, ticker symbol MDT. Now, Medtronic is a company that's actually strictly focused on one segment, medical devices, which in some sense is pretty nice because that means they're hyper-focused and just dominate the industry in medical devices with just that one segment. But on the other hand, if we do experience economic hardships, well, there's always a price to pay for focusing on just one single segment. So pulling up their stock chart, we're going to see, or discover rather, that similarly to J&J, Medtronic actually had a bit of a run-up in 2024 before it slid to $82 per share right now. Now, the run-up occurred when interest rate news came out that we were going to be cutting interest rates. Hospitals and medical facilities would be able to then, of course, load up on what they needed. But clicking to the 5-year chart, we're going to see that the stock never truly recovered from the COVID days, similarly to our economy that has been really all over the place. Interest rates need to come down. But speaking about coming down, let's actually scroll down to discover 3% worth of revenue increasing. Scrolling down even further, a balance sheet that is clean, nearly $90 billion in assets, just $40 billion in liabilities. However, we are here, of course, for the dividends. So let's go ahead and head over to Simply Safe Dividends. We're going to see a solid safety score again at a 99, while the dividend yield itself comes in at 3.39%. Along with a 53% payout ratio, but 46-year dividend streak says it all. In terms of the dividend growth rate, it gets better than Johnson & Johnson with Medtronic, and this one is averaging about 12% year over year. But veering out of the healthcare industry entirely, I want to discuss Stanley Black & Decker, ticker symbol SWK, with you, which is in fact the largest tool manufacturer in the entire world and one of the main suppliers to none other than the home improvement giants like Home Depot and Lowe's. Of course, after a couple of years of jacked up interest rates and just high inflation, home improvement retailers reported lower sales. That makes total sense, but that trickled back to Stanley Black & Decker, of course, as the supplier. So in pulling up their stock chart, we're going to see that when there was talk of lower interest rates or interest rate cuts earlier this year, Stanley Black had its run up, but with the Fed actually pausing, it tumbled back down to $83 per share from over $107 per share. This tells me again, there is in fact opportunity here for the longer term investor. Now, clicking out to the 5-year chart, we will actually see the same exact imagery here when it comes to interest rate cut news over the past 5 years. We're going to see that there were interest rate cuts. Of course, we had a stock that soared, ultimately down now by 49%, which is no joke. However, we will also discover the income statement is very healthy here with revenue continuing to flow in and a balance sheet remaining very clean with assets that trump liabilities, which is what matters most in my opinion. Assets are up by over $23 billion with liabilities at just $14 billion. Now, jumping right into Simply Safe Dividends, we will get a lower safety score here of an 80, but also a solid 3.93% dividend yield. Scrolling down, a payout ratio that's a bit higher than I'd like it to be at 86%, but one heck of a dividend track record after 147 years worth of paying dividends to shareholders, while averaging still a growth rate here of 6% year over year over the last 20 years. Now, investors, there was in fact just one dividend stock on today's list that I'm most excited about personally. Well, it's really going to come down to its higher dividend yield, but more so because it's continuing to grow, and that company is T. Rowe Price, ticker symbol TROW, which is a global money management firm that has just been a Wall Street powerhouse since inception. However, given the firm has a NASDAQ orientation or equity focus, when tech stocks run up, well, so does the firm, and likewise in the opposite direction. So keep that in mind as we click into the stock chart. We're going to see that T. Rowe Price is actually doing quite well, up on the year by 12%. Now click out to that 5-year chart, and we're going to see just how T. Rowe Price ran back up in 2021 and 2022 when interest rate cuts were lower and then tech stocks were soaring. Now scroll down to see the revenue that is pouring in, and furthermore, we get plenty of assets here in terms of assets to liabilities. We are just talking about a powerhouse, but I'm most excited about the T. Rowe Price dividend metrics. So click into Simply Safe Dividends, safety score at an 80, a dividend yield at 4.09%, along with only a 55% payout ratio with a 37-year dividend track record, all while growing by about 14% year over year for the last 20 years. Now, investors, there you have all my dividend stock picks for the day in terms of higher yielding dividend stocks. Let me know your thoughts on all of these stocks down there in the comments below. Tune in right here for a deeper conversation with someone who lost $1 million only to make $1 million plus back, all by investing into dividend stocks. Be sure you're subscribed to the channel, and I'll catch you all in the next one.